state of the Silicon Valley updates, and then finding deals through conversations. This is a Zoom meeting, so if you've been on any of our marketing meetings or any other Zoom meetings, you can have your camera on. That's awesome. We love to see you, but please keep yourself muted, just in case, especially if you've got lots of different background things going on. If you have any questions, put them into the chat box. We're going to get to those at the end of everything. Some of the guys you see on your screen, I'm just going to introduce them really quick. Mike Priolo is our 2021 commercial chair. Rob Silva is a committee member, Marty Lefton, and Ron Cruz. So welcome everybody again. And again, keep yourself muted if you're not speaking. You can raise your hand if you'd like to ask a question or put it into the chat box, and we'll get to everything at the end of our meeting. So Mike, take it away.
Hi, everyone. Thanks for joining us today. My name is Mike Priolo. I'm your commercial chair this year for Silicon Valley Association of Realtors. I've been in commercial real estate for about 10 years. I've been an active agent now for about 5. Over those 5 years, I've personally closed a little over $100 million worth of commercial real estate. I specialize in multifamily and triple net assets. I also do a lot of retail leasing, which is kind of hand in hand with with triple nets. So yeah, I mean, that's kind of just basically my background. Happy to answer any questions you guys have at the end of this. So I guess the next thing to discuss is Crexi, which I think is teamed up with Silicon Valley Association of Realtors and is offering their service. I think overall, my experience, I've been a paying member of Crexi now, I think for 2.5 years. I think it's a really positive experience. It's a great forum to post your listings. It's also a really good forum, I think, for principals. One of the nice things about Crexi is that it allows you to access the listings and deals without necessarily having to pay, versus like LoopNet. It's definitely, you can get like 10% of what's available out there. Crexi doesn't seem to have those barriers as of right now. So I think it's a really good source for finding deals. I've put numerous deals in contract. I found numerous deals that I've put in contract and ultimately closed through Crexi. So I definitely, if you have an interest in getting into commercial, I definitely think it is a worthwhile platform to at least kind of get your feet wet. You can look at OMs, you can look at underwriting, you can kind of get yourself acquainted with how commercial agents market and exchange information for commercial properties. I believe we have a rep named Matthew Coors that's from Crexi that maybe can give you a little bit more information. Matt, are you on the webinar?
Yeah, I'm on the webinar, and Mike, thanks for that intro. I couldn't have paid you to do a better one for me, so that's awesome. And thanks everyone for letting me hop on here. I'll be quick. Is it all right if I share my screen for a second?
Yes, please do.
Yep. Okay, awesome. So hopefully everyone can see this now. So yeah, as Mike mentioned, so what is Crexi and how can it benefit you all? More or less, as he said, we're an open platform. So what does that mean? That means is any broker or agent can list any property they want that they have, obviously listing agreement for on the platform, free of charge. There's going to be no paywall associated with your listings or any buyer, broker, tenant, principal, anyone that's searching the platform across the board can see every listing on there. That's going to be the first thing. There's a lot of really cool tools here. I did a general blanket search here for the greater Silicon Valley area. This is the for lease side. I'll click over real quick. Here's the for sale side. And again, all of this, as Mike mentioned, you can search this and find anything you want on here free of charge. You can come in here and do a filter. You can put in, as Mike said, he was doing triple net stuff. If you only want to look for triple net or absolute net properties, we do have the largest inventory of net lease properties on a national basis. You can get as granular as down to remaining term on lease. So I don't want to get too far in the weeds here, but we are the only platform that allows you to do that too. And really anything that you want to see on here, when you save a search, when you filter that search, you can save it. And this will require you to create an account on Crexi if you don't have one. It's free to create. You can get an email from us daily, weekly, or never, and just run the search whenever you want to get an update of anytime new listings either meet your market because you want to see what's going on in your market, or if you're working a buy side or a tenant rep opportunity and you want to see anything that's coming up on the market, you can do all that again on the for sale, on the for lease side. You just come here and do a filter, and all of that's going to be available for you really easy. And then the next thing I'll mention too, as Mike said, as I click on a property here, oops, my Wi-Fi is going a little bad, so bear with me here. So you click on a property, you're going to then be able to download the floor plan, download the offering memorandum. It will require you to have an account, again, free to create, but it's going to give you that full availability of I can come and download the brochure, understand this lease opportunity, understand the sale opportunity, whatever it may be. And again, it's a national basis too. So don't think that you guys are pigeonholed just because that was the area I was showing you with Silicon Valley here. It's a national basis that you can see everything on. And yeah, you can search kind of across the board. There. And that's, I'm not sure how much more time I got, so I'll pause there. I think it was just for a few minutes. There is an upgraded version, as Mike said, which is called Pro. And that's going to give you access to our database of, marketing and different types of things along those lines, as well as the complete contact information of anyone hitting your listing page, downloading your flyer, etc. I think I saw the title of this was, turn meetings into business. Like that's what our goal here is, to help you guys close more business, more or less, at the end of the day. I'll pause there. Any questions, happy to answer them, and if not, I'm happy to jump off.
Thanks, Matthew. So I think the next, we're going to jump into it now. Ron will be doing the state of the market. Ron Cruz is one of our committee members, and I'll turn it over to Ron now.
The green-wearing Catholic moms.
One sec, guys. Okay, let me share screen. Okay. All right, guys, so just wanted to give you guys a quick update on what's going on for the most part, but I also don't really know everyone's skill level here. So I kind of have a quick background on everything, as well as myself. So I do real estate investment advisory over at KW Commercial. I focus on investment property acquisitions and dispositions, 1031s, portfolio stuff. I'm a member of Filipinos in Institutional Real Estate, which is primarily based up of asset managers, REIT guys, as well as some private equity and family office guys. Part of ARIA, former Silicon Valley CCIM vice chair, and I was former board member at NorCal CCIM. So yeah, train in Argus, have some certifications in CRE, Excel modeling, CFA Institute, working on that right now, and Corporate Finance Institute. I mainly use LandVision, ArcGIS, LoopNet, CoStar, StreetUp, and BuildOut. Kind of follow this approach, just pumping out spreadsheets as well as getting through IRRs and unleveraged IRRs. I like to look at yield on cost more so than cap rates though, and going through it. Cool. So just kind of want to explain where stuff fits in the portfolio real quickly. So a lot of guys just have a quick allocation into real estate. So I mean, there's bonds which are less risky and stocks which are more risky depending on what you buy. Real estate's in the middle. Just alternative vernacular as well as from other presentations. Okay, just kind of going through this quickly because I actually had to cut out some slides since I want us to get to the good stuff, which is finding deals. There's different asset classes such as multifamily, office, retail, and industrial. Then there's the specialty classes such as land and development, specialty on its own, which is like recreational use and theme parks, golf courses too, hospitality, and mixed use. I exclude single family homes primarily because this is based around the Bay Area. If you're seeing single family homes being purchased at like a mill, generally if you go apples to apples with cap rates on investment property, you're seeing 2 to 3% or sub threes. So you're kind of losing out. Granted, I did include this little section here for everyone that's going to be at this presentation. They get this PDF later. If you're doing BRRRR models or getting discounts on properties, you could still make them solid rentals around here. So you guys don't have to fully take notes because this is going to be available to you guys afterwards. I just want to get everyone apples to apples again. There's generally 3 ways to value real estate, which is the income approach, the sales comparable approach, and the cost approach. In CRE, we primarily look at the income approach, which is the cap rates, and we also use sales comps. Most residential guys use sales comps for the most part. Cost approach is more so for development. So for CRE, we're going to be getting the net, which is basically gross income less expenses to get the net income, to get a property value, and that's what everyone sees as a cap rate. It's basically a snapshot, so it's just the trailing 12 from whatever it was valued at. So if you get a cap rate from today, it's probably the T12 rents, whereas the cap rate maybe a month ago was a T12 rents from there. It's always good to reassess the asset. So we have stabilized and core, value add, and opportunistic. Basically, these are really pictorial indications of what they would generally look like for the most part. I mean, I put these side by side so everyone can see a comparison as to where they fit in a portfolio. So you'd see core, which is kind of like the class A stuff you see. Value add, which is what everyone always asks for and wants. I'm sure everyone has those clients. And opportunistic, which it's kind of hard to develop for the most part. Everyone knows that too, in our area at least. So lower cap rates are generally considered stabilized. Value add is going to be on the higher side, and opportunistic or covered land plays generally don't look at cap rates for the most part. Just because there is a basis point spread between one market does not mean it's a good deal for the cap rates. It's always good to figure out other potential strategies and ways to acquire something. And finally, we're here. Okay, cool. We could get to the basics. And yeah, I actually cut out a couple slides here as I was going through this with a couple of friends. And I don't really want to beat this up too much because for the most part, everyone here generally knows what's going on with the housing market. It's pretty hot. I'm not going to be focusing on office either because I don't really do that ever. Not going to go over hotel either because that's a specialty class. For the most part, we're going to be looking at, or this is just a macro update, my apologies. This is from one of the fellow FIRE members. He's the head of CRE at Moody's. As we could see here, based on this graph, it's just a quick thing about what's going on the macro side. Q2 has been crazy. That's when the market dropped. Q3, we got a pump in capital and it just went up. And then we're still seeing similar trends for Q4 of 2020 and Q1 of 2021. Sentiments are getting better as we see more vaccine rollouts. This was just from one of his other webinars when we were just chatting it up. And finally, we're going to be going over these three, which is multifamily, industrial, and retail. Again, excluding office for now. There's, who was that? NIOP does an amazing job for office, so referring to them for a bit. Still good on time. Industrial, cool. So macro updates for industrial, we're seeing Blackstone just sweeping up the nation. We're seeing a lot of other REITs posting up their acquisition criteria all around the block. Sacramento is a hot market right now. And also according to JLL's reports, we're seeing an increased demand flow for industrial space. This is primarily due to e-commerce as well as everyone just going through Amazon. I added some memes because everyone said they wanted this presentation to be fun. So enjoy the memes, guys. This is exactly what is going on right now. If you get calls from people, everyone wants industrial, literally everything else. The universe is falling apart for a bit. Industrial property values, amazing. So yeah, quick through that. This is basically what's going on in our county. We're seeing an average price per square foot for about $330. Unfortunately, I wasn't able to have a more stable or more specialized niche in terms of what is going on in particular because I had to compress this presentation. If you want a more in-depth one, I could send you that over later. Here's what's going on. Shout out to CoStar for some of this data. So here we can see what's going on. One sec, let me move you guys. So the market cap rates are fairly stable. We're seeing like high 4s to low 5s, and we're seeing a lot of absorption happening. In terms of retail, it's a tale of two cities. This is where a lot of people are talking about a K-shaped recovery. We're seeing shopping malls at the bottom of the K. So if you guys were to see a K, kind of like that. Shopping centers and general high street retail is kind of at the bottom, with the other sector of retail at the very top, which is going to be essential as well as lifestyle or neighborhood community centers, which is going to be like your open air shopping malls. Seeing those go up. In terms of what this is in more depth, I actually include this in my blog, which is also going to be in the links at the very end. Here's what's going on with retail. Again, try to make it as simple as possible. McGregor, I'm sorry, man, but that's basically what's going on with retail rents for the most part. Asset managers are distressed, not distressed, they are stressed. They are not going through it pretty well right now. We're seeing things go from, hey, we're developed to empty, such as Sacramento. But I mean, it's also with us too in Silicon Valley. The top of the K is net lease, similar to what Mike does. There's a lot of activity for people looking for stability. It's really hard to find yield right now. Everyone wants stable returns. That's why, similar to this headline, net lease is CRE's shining star right now. Everyone wants a Chipotle, they want a McDonald's, they want a grocery outlet, for example. Everyone wants these things to get yield. And to put it simply, everyone's just investing in these things. They're similar to bonds for the most part, but with real property attached to it. People are buying double net properties, which essentially is everything you would get from a triple net property, except generally you'd have to pay for structure and roof. I'd recommend you talk to someone like Mike, for example, to look into what's in the lease for the most part. And now let's talk about what's going on in our market. We're seeing a decline in the sales to asking price for the most part. Price per square foot is about $481 on average, but this is also kind of skewed because I didn't get to have a heavy filter. Market caps are roughly in the fives right now. A lot of things that are going on are turning into covered land plays for the most part, which is where someone's going to buy a property with the intent to redevelop it, but they have the income on it for now, which is a lease that's going to roll over. And let's talk about why everyone's here. Multifamily. Hey guys. So multifamily is what most people know and love. It's essentially single family, but with more units. It's like, let's see. So for the most part, I didn't want to go over SFR rentals, but we're still going through the forbearance issues. And we're seeing a lot of movements from primary markets to secondary and tertiary markets. There's a lot of pent up demand for Class B and Class C apartments at the moment. And Class A rents are starting to fall quite a bit. So you're seeing stuff in San Francisco or prime product there, reduce their rents to make it make sense. But you're also seeing a disconnect between the people that want to live there. This is the meme section again. Everyone loves this section. I would recommend that you talk to someone, especially if you see these pro formas being put out, to make sure that the rents are actually what they're stating they're at, as well as if the rents can support. Because a lot of people are actually shooting out offers on things that don't really make sense to me. But that's just my personal sentiment. And this is kind of where we're at with rents in terms of that. Great to hear. So as you can see with what's going on in Santa Clara County for the most part, we're seeing an average cap rate about 4.5% or less. I'm seeing less for the most part. Mike could expand on that in his section. And we're seeing price per unit still fairly high. A lot of private owner investors are selling their assets at the moment. They're liquidating because, I mean, right now it's kind of a high for the most part. People are still, there's a lot of demand for yield at the moment, and there's a lot of capital on the sidelines, hence the demand here. As you guys can see by this chart, the general market cap rate along the whole Santa Clara County, sub fours. So if you're borrowing money at like 4.5% and the cap rate's less, you're in a negative leverage situation, but you could also kind of hedge that based on value add strategies. Talk to Marty for more loan info. And as you can see by this, the sale price per unit right now is insane. This is just a T12. This was pulled from a week ago. So as you guys can see, really high price per units. Unfortunately, this is kind of diluted right now. There's some 2 to 4 units in here as well as 5+. But for the most part, the sentiment's fairly solid. Market cap rates, again, 4s or less, with the most transactions happening in Sunnyvale, but this is also large portfolios being moved, whereas these other counties aren't having as much movement. And in terms of my personal sentiments, as well as where the research comes in here, I'm pretty bullish for the most part on San Francisco Bay Area and Santa Clara County, just because we have solid demographics going for us. We have a shortage of housing and investment properties. This is just some nitty gritty. Shout out to Colliers and Newmark Knight Frank. Where's the nitty gritty? There we go. So here's kind of where I'm at with multifamily a bit more. There is still a housing shortage for the most part, and I'm sure a lot of the guys that do resi out here are seeing that. I mean, you guys are writing out 30 PEDs, 20 offers, everyone's getting rejected. So it's like prom and high school all over again. So shout out to nostalgia there. We're seeing a lot of strict policies on development, NIMBYs, high shovel costs, preventing housing to be available. So hence rents are still pretty solid, guys. Just again, my caveat is Class A stuff, kind of rough at the moment in terms of multifamily. So we're still a US gateway market. We're primary, we're predictable, high population, strong in employment, limited housing supply. In our side, at least, we have Prop 13, fingers crossed. And yeah, I'd recommend you rebalance your assets. This is pretty impromptu. I know, Marty, I see you shaking your head. This wasn't fully last minute, but they wanted me to make this as fun as possible. Here's my contact info for more later on. And here is a reference to literally everything that I recommended as well as stated in this presentation. So if you guys want more info on anything, it's all in there. I could also give you travel references, as you could see. That was fun. Cool. Okay, your turn, Mike. That was pretty impromptu.
Thanks, Ron. That was actually really good. That was really informative. So, okay, guys, so basically now we're going to jump into, I guess you want to call it the meat and potatoes of the presentation. And it's basically when I come into a first meeting, whether it be via my own prospecting or a referral, there's kind of a line of questioning that I use to help uncover, the potential seller's needs. And this usually can help, I try to use numerical evidence to help build a case for why you should or maybe even should not list your property or what can we do? What are some strategies that can help the property owner, in this case, realize their goals through real estate? So we're going to do basically kind of a role-playing scenario here. We got Rob Silva. Are you?
Yep, I'm ready.
Okay, so just as a preface, guys, basically we're going to say that Rob was referred to me and he inherited a duplex from an uncle that recently
Uncle
passed.
Marty.
Old Uncle Marty, who has recently passed, unfortunately. It's very, very sad, but so again, we'll just kind of jump right into it. And usually before I go into a meeting, the way that I kind of try and organize a progression in the way that the meeting will go, kind of start with like higher level questions and build off of that. And ultimately that kind of helps build a picture for the client's needs. So, like I said, I'll just kind of jump into it right now. We're going to go ahead and get started. So, hey, Rob, thanks for taking some time to meet with me. Tell me a little bit about the property that you currently own or inherited.
So Marty wasn't very handy, and he did a lot of investment stuff. So he was kind of hands off on this property. And after he had passed, I inherited the property. It's a duplex. It's over Blossom Hill area in San Jose. And I was kind of looking at it. He's owned it for about 10 years. And since it was sent over to me, and since the way I received it, I was kind of uncertain as of, is there a better play here? Should I maybe move into this duplex? Should I keep this duplex? Or is there a better play for me actually making more money if I were to sell it and maybe move up something? Because I kind of waffle between, do I want to take all the calls? Am I going to have to hire a property manager? But let's start with one thing at a time. I'm trying to figure out, do I move into this? Do I not move into it? And
Great questions. So let's talk. You said that your uncle was not very handy. So let's talk about the overall condition of the property itself. I mean, where
not
are you?
Really good.
Not very good. Is it currently occupied?
Currently, yes.
Okay. And long-term tenants, or what's the situation with the?
One's a 1 year, one's a 3 year.
Okay. And what's the unit mix of the building?
It's a 2-1 and a 3-2.
Okay, so it has a pretty favorable unit mix. What are your approximate rents? Do you happen to know that you're collecting for each unit?
So right now, in all, we're capturing about $6,000 a month.
Okay, all right. So for the 3-2, do you happen to know how that's broken out between the 3-2 and the 2-1?
No, I don't.
Okay. $6,000, depending, and you're saying that the condition, it's probably an older condition, maybe a little beat up, right?
A little wear.
So you're probably a little bit below market, but you're not, you're not significantly below market. So, okay, let's discuss that. And you said that you recently inherited it as well, correct?
Yes.
So that would also indicate then that your basis is about to step up. Are you aware of how that works?
I not really. I know there's a Prop 19 thing that's coming in too. So I don't know if that's something I should maybe discuss with you or maybe my CPA. And I don't know if you're comfortable in that conversation or not.
Definitely. Yes. Definitely refer to your CPA. Everyone's tax situation is different, which is a standard disclaimer, guys. You always want to make sure that you state that. But the essence of it is that when you inherit the property, the tax basis is going to step up. It's going to get reassessed. So Uncle Marty maybe bought this property, said 10 years ago. So I was obviously for a significantly lower price. That was right around the depths of our recession. So, you know, he's also ridden a wave of some great appreciation, which could benefit you. But at the same time, you know, what you're up against is kind of a two-way pinch. And what I mean by that is that your basis is going to step up, which means that your property taxes are going to go up. However, you have units that need to be renovated, and you also have long-term tenants. Two units do not have rent control, but you do have to be careful with how much you can increase these rents, right? You're going to have to put money into it either way. And
Right.
assuming that the condition of the building itself is doable, is occupiable. There's not like any kind of major roof leaks or plumbing leaks, or anything that, you know, any major capital improvements that need to happen. You either way, your cash flow is about to get pinched because your taxes are about to go up. So, you know, without jumping too much into the weeds, you know, I think that it would be beneficial for us to sit down and kind of get you an actual valuation of what the property is worth.
Now, how would we kind of go about that, Mike? And from a standpoint, right? Like, I know what my rents are, and then even I think we owe a total of, you know, $300,000 on it, right?
Okay. Yeah.
That's all he owes on it, right? But it needs a little TLC.
Mhm.
And so is it maybe a good investment worth looking at? Is it worthy of maybe moving on?
Yeah, I mean, it's I think so. There's some steps to that, right? And that the question, we could definitely answer that question for you, but ultimately we're going to need to get a little bit more information first. So the first step, and side note, guys, so like basically, you know, like I said, there's kind of a logical progression. You want to get some high level questions in, and then ultimately you want to get an idea. You need to analyze the property itself and figure out how this property is performing. There's a key metric that I'm going to talk about in a second that's called return on equity. And that's going to be determined through doing an analysis. So at this point in time in the conversation, I would be setting Rob aside and telling him, look, I need to collect your books and records, and I'm going to put together so Rob, I'm going to, you know, if you can give me your previous 12 months of expenses and income, and I could put together a valuation based off of, it's a combination of, you know, to Ron's point, of the income approach and the sales comparison approach. And that's going to give us an idea of what we think we could sell your property for. I'm going to have to tour it as well to get an idea of what kind of discounts we may need to make due to the condition of the property. But once we have an idea of what we think the property is worth, I can then give you an estimated, you know, this will be an estimated of what your property tax will be. Santa Clara County has their own ways of you know, increasing the taxes, but I can give you what I think it would be based off of the value. And from there is a metric called return on equity. Are you familiar with that term, Rob?
I'm not really. No.
Okay. So in my opinion, and obviously everyone's kind of got their own methodologies, but I think return on equity is probably the most valuable metric for a multifamily investment property. And it could be even a single family, guys, too. And anyone that has an income producing property, in my opinion, cap rates are nice, but I think a return on equity is truly your metric, because that's telling you what your return is on the equity that you have in the property. It sounds, you know, and basically what we're going to do is we're going to look at what your net cash flow is after debt service. So truly, this is the before tax cash flow going into your pocket, but after you paid all of your expenses, including your loan, divided by the value of the property itself, the value of the property itself. And that's going to give you, again, the return on equity. So once we understand that metric, guys, that is your real key metric there, because, you know, as to Ron's point, oftentimes we see for single family and even upwards of 10, 20, 10, 15 units, the return on equity is sub 4%. You know, you're looking at 2, 3, 4. I've seen 1% in some cases. And individuals, you know, where it gets really tricky is you might have a 20 unit building, and yeah, you know what, you're making, you know, $15,000 a month, and you think that you're killing it, but it's a 1% return on equity. And so you can take this money, once we understand what that return on equity is, right? So at this juncture, we've now agreed to do an analysis, right? And so I've got Rob's in agreement with that. And once we understand what that return on equity is, we can then kind of move into some other investments. And that's going to be the second half of Rob's question. So, you know, I guess I continue this conversation with Rob and such as like, okay, Rob, so what I'd like to do, you know, we're going to definitely have to schedule a subsequent meeting, but if you give me a little bit of time, we are going to, I'm going to put together an analysis for you, a value of the property. Right. And then from there, you know, I can show you some investments that I think, you know, would make sense. Are you familiar with the concept of a triple net?
No, I mean, the most I've ever heard about is like the cap rate, and I was kind of looking for my cap rate answer, but I never really got that. But I'm not really adverse in the triple net. Could you explain a little bit to me?
Yes. So we'll start with your cap rate question. So cap rate is essentially the return on the investment if you were to purchase it all cash. It's the
Right.
net operating income divided by the purchase price, or the value, not necessarily the value. I say the purchase price because oftentimes properties are overvalued. So it's and that is, again, your return on if you were to buy it all cash. So what we'd be looking at, and is we would, the triple net asset, what's nice about a triple net basically is that right now what you're dealing with is a multifamily where you have to deal, it's a gross lease. Number one, you're responsible for all the maintenance, the insurance, the taxes, all of the soup to nuts, so to speak, of the property. You collect a rent, but that's not truly what you're making, right? You have to subtract out a number of expenses. With the triple nets, the benefit to them is that the tenant is responsible for everything, right? The maintenance, the insurance, the property taxes. In a situation of an absolute triple net, I mean, it's all the way down to the windows, the roof, the HVAC. You truly have zero responsibility. The other nice thing about triple nets that you don't get with a multifamily asset is a good amount of predictability. I mean, yes, you can argue that a multifamily asset in the Bay Area is pretty predictable, but we also have seen some crazy things like a pandemic that has just come by, and the benefit, it's a double-edged sword with multifamily, right? The rents, the structure of the rents are they're flexible, right? So they increase with the market, but they also decrease with the market, which means that your value does have some fluctuation. With a well put together triple net, like a Chipotle or like an In-N-Out, you end up with a very stable tenant. You also have a very stabilized lease structure and a predictable lease that gives you the net operating income. So in theory, you would know the value, or you would know your rental income 10 years from now, right? If you had a 10 or 15-year lease, you would be able to see what your income will be 10 or 15 years from now because it's stipulated in the lease, right? And so
So it's kind of more mailbox money instead of me having to be more hands-on.
Correct. And so, and again, this would also, it depends on what your goals are, right? So if you are someone, the other side of looking at this is maybe you do hang on to this asset and you allow it to appreciate. But if you are, the triple net works really well for someone that's maybe not interested in being the real estate manager or investor or getting your hands dirty. It sounds like you're going to have to get your hands a little bit dirty, at least with this duplex, right?
Like Uncle Marty did.
Right. Or maybe like Uncle Marty didn't because he wasn't very handy. So there's that. And if you're looking to, the other nice thing about these triple nets is that because of the lease structure, they actually preserve equity. And what I mean by that is that the rent is stipulated. You have increases in the rent year over year, right? Or sometimes it's every 5 years. That's varies by lease. But because your net operating income is predictable and it's protected as per the lease, the value of the property is more stabilized. So in times of, like, for instance, this pandemic that we're just coming through, these properties, assuming that you have a strong tenant, is these properties retain their value, right? Because the rent has not gone down, right? Yeah. And again, there's always caveats, right? I mean, the triple nets with drive-throughs have actually done very, very well. Sales are up like 34% year over year. Right. And so that's kind of what I'm talking about when I'm talking to you about a triple net right now, looking at the value of what I think your duplex would be worth. You'd be trading into something that we call a quick service restaurant, which is a Jack in the Box, a Hardee's, with what we're all familiar with. Right. So sorry about that, guys, phone in the background. But anyway, so the kind of the beauty of these things is that it is mailbox money. It does preserve your equity. And oftentimes the cash flow is far greater. The return on equity and the cash flow is far greater than what you're making right now. So when you said that you're making about $6,000 a month, right, gross, I would venture to say with your step up in basis, you're probably going to end up with maybe 2,500 of that, 2,500 to 2,000 of that, very easily. And using some rough numbers with what I think.
Gabby, I'm just telling you, I've got some work to do.
Yeah,
so I'm probably not at that number. I think you're being gracious.
I think, yeah. Well, so that's the other thing too, guys, is that I always say numbers that I think we're easily going to beat, right? I'm not gonna, I always try to say things that I'm like, I think you're making this and it ends up being far less. Well, that makes me a little bit more right? When I actually do the analysis. So if it ends up being, if I say, hey, I think you're making 2,500, but in reality, you're making 1,500. Well, now your return on equity is that much lower. And these triple nets that we show you that where you're making $6,000, $7,000 with zero responsibility, become dramatically more attractive, right? So that's all kind of the, I try to, how's the saying go? It's under promise and over deliver, right? And it's simple. Everyone's heard this before, but that's definitely, you try to hedge your bets and you kind of understand the way that all the pieces fit. But that's essentially the kind of line of questioning. So, in the short 10 or 12 minutes that I've talked with Rob, I've uncovered that, basically he has a duplex that he doesn't know what to do with. It has some deferred maintenance, which, most inheritance issues or most inherited properties do, it seems like. He's going to have a step up in basis. He doesn't know what his future cash flows are going to be. And, what to do next is, we'll start with a triple net. Maybe that's not for him. A lot of these investors, they're very comfortable with multifamily and they don't want to move from that. And that's fine, but I think the key for you guys to take away from this meeting would be the line of questioning is to, first of all, like I said, get the books and records and get yourself to a point where you can talk about that return on equity. And you can sit down and numerically show your client, look, this is truly how your property is performing, right? Rather than sitting around and asking them, hey, would you like to buy or sell? It's let's sit down and really show you exactly where you sit at, right? And then, here's where the duplex is at. And here are 5 or 6 different triple nets that will double or triple your cash flow, as well as eliminate the responsibility. A lot of the times too, here in Silicon Valley, everybody has super demanding jobs. And I would say over 50% of the people don't necessarily have the time, the bandwidth, or the knowledge to take on the property manager role, right? Or to get their hands dirty and renovate. So
also, Mike, would you also recommend maybe selling this asset and moving and purchasing another asset somewhere else? Maybe I want to do multifamily. Maybe I can sell it a duplex here and buy something greater in a different territory. Would that
Absolutely. So so basically, in the next meeting, or, we would kind of continue to discuss. And like I said, there's people where I get to the point of like, have you heard of a triple net? And they're like, absolutely not. I want nothing to do with those. And okay, well then you got to dump that and you got to pivot, right? And so then it would be, okay, well, you obviously have multifamily right now. Let's discuss multifamily and what you like about it, because as you said, maybe you move into a newer product type. Maybe you go out of the area, going too far out of the area has its own issues too, right? Because you got to find a really good property manager that's going to be able to manage that asset. Because no matter where you go in multifamily in the nation, it's a hands-on asset. There's no way around that. So yeah, I think, as the agent, you have to be adaptable, and you kind of have to, part of it is kind of poking and prodding and getting some questions out there and seeing where they sit at, engaging their response, but then having the ability to pivot. Because if I said, like, again, if I have you heard of a triple net and you're like, I hate them, well, I'm not going to say, hey, let's talk about Jack in the Boxes, So, it's definitely, but like I said, for me, when I go into a meeting, I usually have a line of progression of questions. The goal would be to get books and records and to do an analysis so that I can numerically show them exactly how their property is performing. Because again, like I said, can't tell you how many times I've run into a situation where they're like, well, I make $12,000 a month on a 15-unit building. And I'm like, your return on equity, but it's a $6 million property. You're making nothing, So, and until people see that, they're thinking just the cash flow is and yes, cash flow is tangible, it's real, but that's not necessarily, just your net cash flow is not necessarily the best metric of how property is performing. So that's kind of in a nutshell. Obviously there's more to it, but I don't want to go into too much into the weeds with it and to get too much into underwriting. That might be something we could discuss in a subsequent meeting, but that essentially, guys, is how I kind of handle a meeting, going into it and questioning.
Marty, do you have something to add to that?
Really? I thought he passed away.
I know, right? He did, but you can bring him back. Mike, I like all parts of it. I also like how you dissect it, right? And I thought you did a good job with all of that. Is there something that you're seeing in today's environment that would make me want to sell this duplex and maybe look at a different option?
Absolutely. Right now, it's so coming out of the Bay Area, this is right with national interest rates where they're at, and with cap rates where they're at for quality triple net assets. The Bay Area, as everybody in real estate knows, is an appreciation market, right? And so from investment real estate, everyone knows, you buy the Bay Area, you suffer on cash flow, but you gain on appreciation. But right now, we're in a very unique situation with even the single family housing market being so much in demand, that you literally could own a, you know, a 3-bedroom, 2-bath house in Cambrian. And if you owned it outright, let's say that on that house, you're making $4,000 a month on rent, right? And, you know, it's just probably middle of the road for something like that. But you could easily sell that Cambrian house and go and buy yourself, you know, 1 or 2 Jack in the Boxes and turn that $4,000 into $8,000 or $10,000 because of how cheap interest rates are, the cap rates that are being presented with these Jack in the Box or Hardee's, you know. And so if you are Bay Area residential real estate owners right now are in an extremely advantageous, unique situation. So I would think that, you know, if you have any clients that are sitting on a single family home, duplex, triplex, 4-unit, it is a really good time to sit down with them and discuss, hey, look, let's look at exactly how this property is doing for you. Because let's say, again, with the Cambrian example, right? $4,000 a month, that's $48,000 a year. If it's worth, you know, let's say 1.7 million, right? I mean, you guys can do the quick math on that. I mean, they're making, you know, 3-4% on their equity. So the net cash flow of it. And it's a really good time to take a look at helping your clients expand their portfolio, get into commercial, increase their cash flow, protect their equity. You know, the list goes on and on. So it is definitely, this is the time to sit down and talk with your clients, guys.
And I don't have to manage it.
And you don't have to manage it.
Right?
So yeah, I'd say, you know,
That's
so Ron just did the math. That would be a less than 2.5% cap rate on that example that I just said, guys. And a very middle of the road cap rate for a quality Hardee's or Jack in the Box is like 5.5, 5.75. So, you know, the cash flow quickly doubles. It becomes, you know, when you look at it on an apples to apples basis, it becomes almost a no brainer. The only holdback would be, you know, if someone has some sort of, they're married to the Bay Area or they hate commercial. In which case you're probably not gonna have them as a client anyways, guys. So
Hey, Mike.
yes, sir.
A couple things. So Rob, I came back to life, just so you know.
Oh, good to see.
Welcome, morning, man.
Just kind of so the group knows, the interest rates on like those triple net properties he's talking about, they're still going to be probably under 4% for 10-year fixed money. That's the one part. The other thing, Mike, that I think might help these guys is, I know you've had the discovery questions and everything else, but let's pretend they all have their clients, and some of the clients are looking to leave the area or you know, sell their property, get some equity out, et cetera. And some of their clients have single family rentals. And so how would you suggest they just open up that conversation with the client so that they're more seen as an advisor to the client?
Yeah, I mean, I guess, so you're saying they have a portfolio, let's say, and they have single family mixed in with some multifamily, something like that. Is that kind of where this particular owner?
Well, I think what I'm looking at is I'm looking at like who the audience may be.
Yeah.
And assuming that they're predominantly residential realtors, often they're going to have somebody that has an investment property in their portfolio somewhere. And it could be anywhere from 1 to 4 units for all.
Mm-hmm. Mm-hmm.
So in reaching out to them, what type of questions should they be asking to, in effect, get the client to want to say, tell me more?
Yeah, I mean, I think, you know, one thing, the simplest one would be, you know, would you be interested in learning how you could double your cash flow? You know, would you, you know, right now, as I touched on as well, we're in a, you know, everybody knows this is very much a seller's market in Silicon Valley for single family homes. So selling the property, I think, is less of really the question, but more so it's maybe sitting down and talking with them about, you know, what the upleg would look like, or here are some strategies to help you diversify. Let's say that you have 5 single family homes, right? Like that's great. You probably have a bunch of equity, but you lack diversification, right? And unless you have a manager, you're probably running around trying to, you know, keep these properties together, or you have to manage your manager. So, you know, I think that sitting down with them and talking to them, understanding your client. So, you know, understanding where your client's at in life, I think is something. If they're looking at retiring, maybe they're going to want to streamline things. Maybe they're going to be interested in stabilizing their equity and the appreciation wave. You know, they've gained the appreciation. Anyone that's bought anything 10 years ago, you know, like you, Uncle Marty, you know, for anyone that has something where they're sitting on a bunch of appreciation, they should probably consider taking some of that equity, maybe do a cash out refi and diversify and getting into commercial. So you don't even have to get rid of the original property if there's value, you know, if you're married to the property, so to speak, or emotional attachment to it. So I think it's sitting down and really understanding, trying to have some conversations with your clients and figuring out what their goals are, and trying to understand where they're at in life as well.
No,
And
that
you
makes
see
sense.
Out in life, sorry, Marty, you say out in life in a good way, because most of the time triple nets are designed for somebody at a later time span. They're not always for a right away.
Correct. Yeah, I think the triple net benefit, or the benefits of it are that it's mailbox money and that it is an ease of management. I think that, and that's and it also preserves equity, right? So that's gonna resonate with a lot of the older, more conservative crowd. I do think though that triple nets also, if you get a well-placed one, because of the way that they've performed through this pandemic, they can be a hedge on your portfolio. Let's say that you have, I don't know, you want to get some diversification, right? And these things,
Right.
that they can definitely help keep the net operating income of your portfolio healthy during times of instability. So, I think that it's not only for the older investor, I guess is what I'm saying. Let's say maybe you're a developer, right? And you have some really high risk stuff, but you also have some equity in some investments that are doing well. Maybe you want to place that equity into something that's going to give you a little more cash flow.
Perfectly said. Also, I get a lot of stuff. Well, where's the COVID discount?
And triple nets doesn't exist.
Right?
Yeah. They're not there. I mean, like to Ron's point, I mean, the triple net, the single tenant net lease, especially with the drive-through, has really kind of been a darling through COVID. Their sales on average for these quick service restaurants, as I said before, is up like 34%. They're all doing really well. They've been able to quickly and easily pivot to the new pandemic lifestyle that we've all been forced to live. So I haven't seen, if anything, I've seen the demand go up because interest rates have also gone down. So these have performed well, money's gotten cheaper. That is a recipe for more demand, and there is not a whole lot of COVID discount.
No, that's very well said, but at least it answers the question.
Yes.
Going back to the realtors that have clients, et cetera, I think what I heard Mike keeping it simple for them is, I think they should be reaching out to their clients and just having a conversation and saying, hey, 'cause they always want to touch base for some reason.
Yeah.
To keep the relationship. But I would imagine they would, with their clients that do own investment properties, just saying, hey, wanted to check in with you. I was listening to this guy at SCORE, Mike Priolo, and he was talking about ways that people position the properties. I was thinking of you, Mary, whatever her name is, and I was just curious, you've held these properties a long time. When you first bought the property, what was your objective? And has that changed since then? And then that opens up a conversation to figure out, it's kind of like financial planning in real estate, is trying to figure out, have the objectives changed? Because one of the things you stated is people typically start out where they have a home, they move out and they rent the home that they were living in. And that's their first entree into investment real estate. And they may get the bug and buy more and more. And they'll do this until they get kind of tired of managing them.
Yep.
And then they go, hopefully somebody introduces them to, wait a minute, there's another way to do this where I don't have to have all these headaches. And that's where you come in, Mike, and you can show them an alternative, much like you've done with some of the people you and I've worked with.
Mm-hmm.
But I think for this group, just talking to their clients and just being a resource, it will open up discussions. And that seems to be pretty straightforward.
Yeah, no, I would agree. And again, guys, it's a very unique time right now for residential real estate. So the single family home can easily catapult someone into commercial these days with the values and interest rates that we're seeing. So it's not, you don't need to have, the big multifamily, or, there's not this barrier, this unforeseen barrier for getting into commercial anymore, especially with the environment that we're in.
I think
Do any of these folks have questions? Because I've been looking at the chat box. I haven't seen too much.
I haven't seen any, but I do want to open it up. And the other thing I want to mention is you guys are talking about buying Jack in the Boxes and franchises, things like that. And I think one of the things that I've learned from you guys is it's great for you as a residential agent to sell the house and then talk to one of the commercial agents to help them purchase the franchise. Would that be a fair thing to say? They can sell the house, but you guys should handle the commercial piece of it?
Yeah, I think, the way to go about it would be find a commercial agent that you're comfortable with, but, you can kind of come in as a tag team, because I think, most people right now realize that, selling the house is not that's not necessarily the issue. It's what do I do next? Where do I take my money? Where do I put it? And what's a smart play? And so having that commercial agent come in, after you've listed the property, or even, when you guys are in the process of selling it, and explaining to them, look, here's some strategies that have worked with other clients. Here's what we can do. Here's where we could place your money, will help bring some ease, especially if they are selling a single family. And like to Marty's example, they lived in it before, they have 2 single family homes. They're not necessarily the most savvy real estate investor. This can become a bit intimidating. So I do think that there would be some value. It would help you get listings in the future too, if you can help them, show them, hey, look, this is a 1-2 thing. We have an end game for you. It's not just sell your home and hope for the best.
Does anybody have any questions? You can raise your hand, put it in the chat box, unmute yourself. Looks like Annette might. There we go. Annette?
I have a question. Yeah, Mike. Hi.
Yes.
Hi,
Hi.
I'm Annette DiResta with Morgan Hill Real Estate, and I've
Annette.
been in residential since 1999. I do have a question about a friend of mine's mother has owned a property. She lived in Belmont for, I think she said 50 years,
Okay.
and then moved up to Fairfield, and now she has to go to a nursing home. So
Yeah.
if she has a couple $100,000 in equity, but she has like 100 for living, the first couple of years, what would you recommend possibly where instead of just, selling her house and using up all the money for care, is there something else that she can do to have that steady cash flow? Because who knows how long she's going to live.
Absolutely. So, you said that she has a couple $100,000 of equity, or is it a couple $100,000?
Yes.
Okay. So typically I would say, it becomes a little bit tough with the dollar amounts, only because, with commercial, typically you're seeing, 35% down for what kind of properties that we're talking about. So that doesn't give a whole lot of purchasing power into a triple net. And the nice thing about it, the problem with a couple $100,000 is that it's finite, right? So if she's spending $6,000 a month on the nursing home, right? That's, you could do the math. That's 72 a year. That's like 3 years, right? 2.5 years, and they've exhausted the funds and they're gone. I think you would want something that's going to give you some cash flow. I think that the triple net may be a bit risky for this particular individual, mainly because, again, $200,000-$300,000, at 35% down, you're not going to be getting into the higher quality triple nets. But I think that it would be wise to find some sort of an investment that's going to pay some sort of a cash flow. I think that situation becomes a little bit tricky there, from a triple net standpoint, at least.
So here's the second part of the equation then. If she has 4 adult kids, one owns a print shop in Davis, the daughter in Elk Grove, I don't think she works. One son is retired American in Texas, and then a son down in Orange County. I don't know if you could recommend some type of strategy where maybe all the kids gather together and do something where they could purchase something in the future to protect her in case there is longevity.
Yeah, I mean, something that you could do there would be, that you would want to set up maybe a trust or an LLC of some sort, and you can have the ownership divided however they decided to do it, but you would want to, pool your funds and have an LLC then, which is not uncommon in commercial real estate, an LLC that purchases the triple net, let's say in this case. And that could be, this would require, you want to get some attorneys involved, but you'd have to have some agreements in place. But the high level of it would be a strategy could work where they create an LLC, they buy a triple net with the agreement of keeping mom afloat until she's done with the cash flows from the triple net. And then at the end of that, you could sell it and dispose of it based on the percentages of the equity that you put in to originally buy it. That would be kind of a quick high level strategy that you could do. There's a number of different ways of kind of slicing that pie, but that might be something that they could consider. But this way, at least they're going to, at the end of this, they're not just going to be shelling out money for mom, and that's just negative cash flow for them. They could have something paying it for them. They can also get some appreciation, secure, and at the end, maybe even make some money when they go to sell that asset.
Thank you.
Of course.
Just
Hey,
to
Mike.
to follow up on that, Mike,
Oh.
and that I would suggest a couple of things. One is I would get really clear on what the objective was for both the mother and for the kids in this case. And once you get kind of like what their needs list is, that will help dictate where the next steps will be, whether it'll be owning investment real estate to cover mom's bills, whether there's enough equity in the property that she owns to do some sort of reverse mortgage, which I don't know at that stage. There are a lot of things out there, but usually the needs will dictate what the eventual solution will be.
Totally agree with that. I mean, it may be wise, Annette, with this case is to do an analysis, do a CMA on what you think that Belmont home is worth, get an idea of where their equity is there. That would be a starting spot. And then, I don't know what your relationship is with the other siblings, but it may be at that point in time, you can maybe sit down with them and have a discussion as to, some strategies. And like Marty said, kind of learn what their goals are and what they're willing to do. I mean, oftentimes it's hard to get all siblings unified in what they want. Unfortunately, I've seen more often than not that, it's very difficult to get siblings on the same page. So, and again, you would definitely want to make sure that all this is in writing and you have attorneys and you form, you'll go through all the proper channels, but that kind of be the high level way of going about it.
Hey, Mike, I had a question.
Yeah. Hey, Chico.
Can you hear me?
Yes, I
So
can.
I've got a client right now that wants to sell here in San Jose, move to Gilroy. He owns the house free and clear. He's going to pay cash for the whole house down in Gilroy. But listen to this discussion. I think maybe he should leverage that money after he pays it off and refi and get something else commercial wise, even a triple net. He's like 70 years old.
Absolutely. I mean, money's for residential, especially if he's going with a primary, it's never really been cheaper, right? So
correct.
He could, you could go and buy that all cash and then you have no mortgage payment, but you still got property taxes, right? So that's nice, I guess. But if you could, take that and have a triple net that's going to be paying you your mortgage plus some spending money,
right,
then you're putting your money to work for you. It makes a lot more sense, in my opinion.
Okay. I'll reach out to you on that.
Sounds good. Thank you.
Are there any more questions that are out there? And I will send everybody an email after this with Mike, Marty, Rob, and Ron's contact information so that you guys have it. Are there any more questions, or do any of you have any final thoughts as we wind down to our hour? Nope. No questions, no final thoughts from anybody? Mike, Ron, Rob?
Thank you all for your time.
Mike, you did great.
Thanks,
Yeah,
Rob.
that was I think a lot of good information for everybody on how to have those conversations. So thank you. And we'll be doing another one of these in a couple months. So if you have anything that you want to hear about, if you have a topic or anything like that, go ahead and respond to the email when I send you the contact information and let us know what you want to learn about commercial, and we'll put something together. So thank you, everyone.